Hi everyone, and thank you for tuning in. In today's video, I'm going to answer the question if Target stock is a buy. I'm going to use my simplified 6-step framework for analysis, and you'll get the answer before the end of the video. So let's jump right into it. The first step in my framework is customer value. For Target, its product prices, its pricing policy is that it's more expensive than Walmart and Costco. It's not aiming to compete. It's not aiming to add value to customers by having the lowest price. That's not its strategy. For Target, it adds value through convenience. It has almost 2,000 locations in the US. It has upgraded stores. Its stores are nicer. It has excellent fulfillment services. You can buy online, pick up in store. You could buy online, drive to a Target parking lot, and an employee will be waiting there to hand you your item in your car. And you can buy online and have them deliver it to you within a couple of hours in the same day for a small fee. It has wide product selection, so it has lots of different items, different categories, and overall it tries to offer a better shopping experience. You're not going to be in skinny aisles with several people around you rushing and cramped space with poor lighting. It's got a more inviting atmosphere, wider aisles, more selection, just a more pleasant experience for those folks who want that, who maybe are willing to pay a little bit more in order to have a better shopping experience, who don't want to be in the cramped spaces of Costco where you can hardly move your shopping cart. Maybe they are offering you better prices, but you're competing with other people who are looking down the aisles. You can't stop for a moment to look at the items. You've got to be constantly moving because the shopping cart behind you is pushing you along. And so it's not as pleasant a shopping experience as when you go to a Target. That's the value that it adds. And it's understandable that it's not going to experience the high level of revenue growth because it's not turning over as much, right? It's not like a Costco that sells the same item more often. Target does the other thing, right? It sells items less often, but it sells it at a higher profit margin. Overall, revenue has increased from 73 billion to 106 billion from 2013 to 2022. So there's evidence that customers appreciate the value that Target provides. Otherwise, they wouldn't keep going back there, and Target wouldn't be able to generate over 100 billion in revenue from just one country. So the next step in my framework is unit economics, and Target does a solid job in this, right? They sell items, like I mentioned, less frequently at higher profit margins. Its gross profit margin averaged 30% in the last decade, which is the highest among the competitors that I mentioned before, Walmart and Costco, and even way higher than Amazon's gross profit margin. And so that strategy is working. It is able to generate these higher profit margins, and overall it's helped operating income rise from 5.6 billion to 8.9 billion from 2013 to 2022. The next step in my framework looks at the total addressable market, or the size of the market opportunity, and according to the US Census Bureau, retail sales totaled 5.6 trillion in the US in 2020. Now Target doesn't operate in the entirety of that segment, but the majority of that segment Target operates in. It sells electronics, groceries, clothing, baby items, all sorts of things. So it operates in a massive market opportunity. Competition is a big one for Target. Now it's facing some formidable competitors in Walmart, in Costco, and even Amazon. These are strong companies. Each is approaching the category with a unique strategy. Costco offers the lowest prices on bulk sizes with fewer selections. And online sales are less emphasized for Costco. Costco wants you to come into the store. They don't want to do online sales because then those are less profitable. It needs to pay for shipping. And so if you shop online with Costco, you're going to see higher prices than you'll see in store. Amazon is almost exclusively online if we don't look at its Whole Foods and Amazon Fresh stores for grocery. It's focusing on faster delivery of a massive selection of items. That's where it used to try and get 2 day shipping. Now it's got 2 day shipping on most geographies. It's trying to get to next day shipping, and it's even trying to get to same day shipping. So it's trying to get to a point where it can get you the items you order online faster and faster and faster. And that's where it's competing. That's where it's investing billions and billions of dollars. Just in the last 2 years alone, Amazon has spent over $100 billion, mostly on its fulfillment, on its logistics, and trying to get you your items faster. Walmart is a combination of all of the things. Walmart offers lower prices on a wide assortment of goods, and it uses its powerful purchasing power to drive supplier pricing lower. So Walmart overall has the highest retail sales of any company worldwide. It's approaching 600 billion in revenue and annual revenue. And so it uses that massive buyer base to tell suppliers, hey, look, if you want to have access to our shoppers, you need to give us lower prices. And then it takes those lower prices and offers savings to its customers. That's Walmart's main MO. That's how that's its main advantage as well. And so you can see here that each of their competitors is taking a unique approach to it, and each is viable. Each is gaining large market share. They're all, Costco just reported over 200 billion in annual revenue. Amazon is over 500 billion in annual revenue. Walmart is approaching 600 billion in annual revenue, and Target is a little over 100 billion. But Target is exclusively in the US, whereas all of these competitors are in other countries as well. So it's in a tough competitive industry. Valuation is the next step in my framework, and Target is trading at a price to earnings ratio of 17.2, which, looking back at its history, we can say over the last 5 years it's fairly priced, right? It's been more expensive in the past. It's also been cheaper in the past, as low as a PE of 10. And so at 17, it's about in the middle between the low of 10 and the high of 25. So we could say it's relatively fairly priced. The final step in my framework considers risks, and for Target, the primary risk right now is inventory levels are extremely elevated. They went through a period of time where they faced inventory shortages. They had out of stock and they were sold out on a lot of things because the pandemic caused supply chains to be disrupted worldwide, and so they over invested in inventory. And now that consumer behavior has shifted and we're spending more time on away from home items and away from home experiences, that's left Target with an elevated level of inventory. They've started offering major discounts in certain categories to try and get rid of some of that inventory, but the risk remains that they're going to need to offer even bigger discounts to get these things off their shelf. So that's the primary risk right now. The second risk I noted here was that inflationary pressures are rising. They're having to pay higher wages. They're having to pay higher cost of goods sold. Transportation, fulfillment expenses are higher. And all of this is happening at the same time that their customers are spending more on away from home items. So they're spending less at Target and they're spending more at restaurants and ball games and theme parks. And so this combination is an elevated risk for Target as well. So now that we've looked at all of their frameworks, let's give them a grade. I'm a university professor. I've been teaching finance and economics for a couple of years now, so I like to give things grades. And so let's give each step of targets in my 6-step framework. Let's give it a grade on each step. For customer value, I'm giving Target a B+. They're doing a good job with that slightly premium customer. They're not going after the lowest cost. They're not trying to be the lowest cost provider. They're offering a good experience for that slightly premium customer, and it's clear that customers like what they're offering. So B+ for Target there. Unit economics, I gave them a B+. They're doing an excellent job. They have higher gross profit margins than all of their competitors at 30%, so I gave them a B+ there. They're also very profitable on the bottom line, so good unit economics. Total addressable market, I gave them an A+. Retail industry in the US is absolutely massive. They're in a healthy market, A+ there. Competition, I gave them a B. For there was two factors pulling their grade higher and pulling their grade lower. Pulling their grade higher was its history in successful performance in this industry, and pulling their grade lower is the fact that they're in a fiercely competitive industry with formidable competitors. So pulled in both directions, they get a B there. Risks, I gave them a B because of the heightened inflationary pressure and the way higher than usual inventory balance that they have. They're going to need to offer big discounts to get those off the shelf. Valuation, I gave them a B. The stock is not expensive, but it's also not cheap. It's fairly priced, so I gave them a B here. So now that we've looked at the grades for all the steps in my framework, let's answer the question if Target stock is a buy. Target stock is a buy. They're operating in a massive industry. They have evidence for decades in competing effectively in this industry, generating healthy profit margins. And for that reason, I say Target stock is a buy. It's never a bad thing to pay a fair price for an excellent business, and that's what Target is offering investors a chance to do here. You're paying a fair price for an excellent business. Investors will do well over their investing careers if they continue that over time. So Target stock is a buy, but let me know what you think in the comments down below, and I'll see you next time in the next installment of Is This Stock a Buy? Thank you for watching, everyone. I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for all investors of all skill sets and risk levels. So I'm proud to partner with the Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 3 times. Go to fool.com/Parkev to get your 10 stock picks now.